Only 6 weeks left. Yes, 2023 is almost over. This year has flown away so quickly, but don't let your money fly away from you in the form of taxes. In this video, let's look at 5 things you must not overlook as 2024 approaches. This can help you strategize and can save you thousands of dollars in taxes. None of this is financial advice, only information you might find helpful in taking decisions with respect to your money and taxes. Let's begin. First on our list is contributions to the First Home Savings Account or FHSA. If you have somehow missed it, this year the Canadian government introduced a registered savings account for first home buyers. It is specifically designed to assist individuals in saving and investing for the purchase of their first home in Canada. Similar to the RRSP, the FHSA offers tax deduction that can reduce your annual taxable income. But that's not all, it lets you generate tax-free returns on your savings and investments similar to a TFSA. If you are 18 or 19 in some provinces, you are eligible to make use of this account. There are specifics to what qualifies as a first home, so I encourage you to watch some videos including mine, or consider reading the official CRA website for more information. The FHSA contribution deadline is strictly December 31st of each year, and you can contribute up to $8,000 annually. The lifetime contribution limit is $40,000. If you have not contributed anything to your FHSA so far, I understand that $8,000 is a lot to contribute by December end. So make your best effort to do as much as you can. It can save you thousands of dollars in taxes. For example, if you made $80,000 in 2023, it can reduce your taxes by about $2,300. That's an additional $2,300 you get back when tax season rolls around. The FHSA allows you to carry forward up to $8,000 of unused contribution room from one year to the next, allowing for a maximum annual contribution of $16,000. So, if you contribute $3,000 this year, you can contribute $5,000 plus $8,000 next year. But just try to make use of it to some extent this year too. The second one, you guessed it, it's contributions to your Registered Retirement Savings Plan or RRSP. Contributing to your RRSP allows you to deduct the contributions from your annual taxable income, reducing your tax liability yet again. The contribution deadline for RRSP is typically within the first 60 days of the next year. So technically you can make contributions up to March 1st, 2024 and still include it as deductions for 2023. However, making contributions by the end of the year is ideal if you like tracking finances from January to December. That's what I prefer doing. As a quick reminder, the contribution room for your RRSP can be found in your previous year's tax filing in the Notice of Assessment, or you can also check it under CRA. As a rule of thumb, it is 18% of your prior year's income plus any carryovers from previous years. In case you are a high earner, remember the contributions are capped at $30,780. Try to maximize your contributions to get back as much taxes as possible in 2024. Please remember, you don't need to invest or allocate your money, it just needs to go into your RRSP accounts. I'm making contributions all the way until the end of December, but I won't be allocating the money until I find the right investment opportunities. In the meantime, at least I get some taxes back next year. If you're new to Canada and moved here in 2023, you do not have any room for your RRSP yet. Your contribution room starts next year based on this year's income. Next on our list is tax loss harvesting. If you're an active investor, consider taking small hits to your portfolio to implement tax loss harvesting strategies. For anyone not familiar with it, tax loss harvesting is a strategic financial move when selling investments within a non-registered account for less than their adjusted cost basis. This triggers a small capital loss. This loss can be used to offset capital gains within the same account. For example, if you sell an investment at a loss of $500 while realizing a gain of $1,000 from another investment, your taxable gain becomes $500, reducing your tax liability. There are some key considerations for this strategy. First is superficial loss. When employing tax loss harvesting, make sure to consider CRA's superficial loss rule. According to this rule, investors claiming a capital loss on the sale of an investment cannot buy the same investment within 30 days of the sale. Second, portfolio rebalancing. Tax loss harvesting strategies can be used to rebalance your portfolio. This is the main reason I decided to implement this strategy this year. I sold some of my losers to move money into more high conviction assets. This way, I save on some taxes and get better sleep knowing my money is parked in better assets. The third one is eligibility. Tax loss harvesting strategies can only be applied to non-registered accounts. This means you cannot apply this to your RRSP, TFSA or the FHSA. Use this strategy wisely and only only if you need to. The fourth one is to utilize tax-efficient rebalancing. We just saw how you can use losses to reduce your taxes while rebalancing your portfolio. However, I would like to discuss this in the context of TFSA or tax-free savings account. To begin with, we have a contribution limit of $6,500 for this year on top of all the previous year's limits. We know that any growth of money in this account is tax-free, but the contributions are not tax deductible. So, how do we save in taxes? Consider this, you have contributed to your TFSA in the past years and maybe this year as well. However, for some reason you have fallen short of contributing to your RRSP or your FHSA, which are indeed tax deductible and can help you save taxes. Under the CRA rules, you can withdraw any amount of money from your TFSA before December 31st and get the contribution room back next year. This means, for example, you can take out $8,000 from your TFSA account for contributing to the FHSA and next year get your $8,000 room back along with whatever is the new 2024 limit. This is a great way to save taxes. You can also take out money from your TFSA and contribute to your RRSP. The main thing to consider here is whether you can take out money from your TFSA account without losing out on good investments. For me, it's not the right option because I'm fully invested right now and cannot find any sellable assets. If it's possible for you, consider it as part of your tax strategy. By the way, if you're new to Canada and don't know your TFSA contribution limits, consider checking CRA. But I would caution, for me and a lot of my friends, it was wrongly mentioned. It's an easy calculation using this table. CRA puts the blame on us if we get it wrong, so make sure you calculate it properly. Simply put, if you moved to Canada in 2019, your contribution room limit starts from that year. That means today it's $30,500. Finally, the last one is to consider maximizing all miscellaneous tax credits. In Canada, there are several tax credits that can greatly reduce your tax liability. Start making a list of them and put together the documents you need to claim them when tax season rolls around. Here are some examples. The Canada Employment Amount provides an automatic credit for work-related expenses such as uniforms, shoes, clothing, or necessary supplies. This credit acknowledges the costs associated with maintaining a professional appearance at work. For example, this may be valid for medical professionals or factory workers. Charitable donations offer another avenue for tax relief, allowing you to claim back between 15 and 33% of your donated amount. Moreover, you can maximize this benefit by combining donations over a 5-year period and claiming them all at once. I know the world's been rough over the last few years, and if you have shown your kindness to the world, the government rewards you with some tax breaks. Finally, for those pursuing education, the tuition tax credit is really important. You can receive a 15% or more credit for eligible tuition expenses. There are also some random ones. If you stay informed and support Canadian journalism by subscribing to a digital news source, you are eligible for the digital news subscription credit. There are several other tax credits that you can claim, even more so if you have dependents or kids. So make sure to check them out on the official CRA website. I would not call myself an expert on all tax credits, but since I moved to Canada as a student and spent upwards of $100,000, I know the student tax credits can be extremely valuable in offsetting high education costs. At the end of the day, do what's best for your situation. Inflation's been high and you have had to spend so much more over the last year. So make sure to implement some of these strategies and get back some of your money. I hope you got some valuable information from this video. If you did, hit like and consider supporting my channel. Till then, keep learning and stay on top of your finances. Until next time.